Another one bites the dust. Last week, Bitcoin prices took a hit, tumbling down to a fresh 52-week low of 15,500 and change. Now you'd be forgiven for not thinking much of this blip. After all, Bitcoin prices have already been in free fall for the past several months, having shed over 70% of its value since this time last year. This time, Bitcoin's price drop had nothing to do with macroeconomic forces like geopolitical issues or rising inflation. Instead, what happened was strikingly similar to an event that happened earlier this summer that shaved $10,000 off of Bitcoin prices. FTX gets FX'd. Crypto exchange FTX, founded in 2019 by MIT graduate Sam Bankman-Fried, was formerly the third largest crypto exchange by volume in the world. Alongside respectable peers like Binance and Coinbase, FTX was held up as a prime example of the glowing future of crypto. With Bankman-Fried at the helm, who is lauded as a crypto genius, FTX led the push to bring crypto to the masses. The company spent millions on marketing, with superstar athletes like Tom Brady and Stephen Curry acting as brand ambassadors. They took out an ad spot at this year's Super Bowl, sponsored both traditional sports and esports organizations alike, and even donated heavily to politicians and lawmakers. But it all started tumbling down for FTX, formerly the cleanest brand in crypto, 2 weeks ago. On November 2nd, a leaked balance sheet from FTX's sister company, a crypto trading firm named Alameda Research, was published by the crypto news site CoinDesk. Alameda Research, which had also been founded by Bankman-Fried, had an unusually close relationship with FTX. What CoinDesk reported, however, was just how closely intertwined the two companies were. According to leaked balance sheet, 40% of Alameda's $14.6 billion in assets were held in FTX's own crypto token, known as FTT. Having such a large portion of its assets tied to FTX's illiquid token raised many questions in people's minds about the true nature of the relationship between Alameda and FTX, as well as their financial stability. In the real world, those would be consolidated in the same company, but apparently crypto's different. Laws of power crush your enemy completely. One person that realized this was Changpeng Zhao, known as CZ, CEO and co-founder of Binance. He tweeted just 4 days later that Binance would be selling all of their remaining holdings of FTT. Though Alameda's CEO quickly replied, offering to buy Binance's FTT tokens for $22 each to minimize market impact, the damage was already done. Panic cascaded through the industry, and the sell-off began. By early last Tuesday, November 8th, FTT would fall from 25 to below 10, as FTX customers started a bank run, or a crypto run as we should call it, to withdraw money from their accounts. This would lead to a liquidity crunch at both FTX and obviously Alameda, and Bankman-Fried, realizing things were rapidly spiraling out of control, reached out for help. The crypto plot thickens. Thanks to Bankman-Fried's efforts, Binance offered to buy out FTX later that same day after some initial negotiations, subject to due diligence. But it'd only take 1 day's worth of due diligence for Binance to walk away, citing mishandled customer funds in alleged U.S. agency investigations. As it turns out, there was much more to the story than just poorly diversified illiquid assets and a cash crunch. Both the U.S. Securities and Exchange Commission as well as the Justice Department would join forces to launch an investigation into whether or not customer assets were handled appropriately. They have also investigated whether or not some of FTX's offered products should actually have been registered as securities with the SEC. It came to light that FTX had been loaning billions of its customers' funds to Alameda to fund the latter's investments against FTX's own terms of service. Interesting. On top of this, the company was also accused of front-running FTX clients by amassing tokens before they were listed on FTX, which would potentially be a form of insider trading. With Binance outright stating that FTX's issues were beyond our control or ability to help, things swiftly collapsed from there. On November 10th, last Thursday, Bankman-Fried announced that Alameda was being wound down with the intention of repaying all of FTX's customers and other liabilities. Good luck. All the while, FTX's assets were frozen by regulators in the Bahamas, where the company is based. Then something interesting happened a day later. Alameda, FTX, and their affiliate entities filed for Chapter 11 bankruptcy. And it was a pretty bad day. Later on that day, FTX was hacked, possibly costing the exchange almost $500 million in crypto assets, the icing on the cake. Or were they hacked? Or was it an inside job blaming the hackers? This is a pretty thick plot. The Treasury and the SEC have to regulate. As of the time of writing, the FTT token has fallen by over 90%, evaporating nearly $3 billion in market value. That's a chart you're looking at the FTT token over the last 30 days. Earlier this year, there was a spat of similar bankruptcies. In the wake of the Terra Luna failure mentioned earlier, which single-handedly caused Bitcoin to fall from 40 to 30,000, there were also crypto lenders Celsius and Voyager, and hedge fund Three Arrows Capital that went bankrupt during the fallout. In fact, Voyager had just recently come to an agreement with FTX for the latter to buy out Voyager's remaining assets, but now they'll need to find a new buyer. Wow, that's a pretty leveraged, intertwined plot. The Lehman Moment for this crypto generation. But none of them can compare to the failure of FTX, which many have likened to a Lehman Brothers moment for the crypto industry. This is unique for tens of millions of new investors just had the rug pulled from underneath them, experiencing their own Enron or Lehman moment. As an industry leader, Bankman-Fried had previously been leading lobbying efforts to shape the future of crypto regulation in the US. Just 1 month earlier, he had penned a set of possible digital asset industry standards in which he espoused an FTX-friendly regulatory framework. In fact, last December, Bankman-Fried had testified before the House Committee of Financial Services chaired by Congresswoman Maxine Waters on the future of digital assets and finance. To quote BF directly from that hearing, to be sure, there are irresponsible actors in the digital asset industry, and those actors attract the headlines. But FTX is not one of them. We're just not sure if you meant to attract the headlines or if they were irresponsible actors. I'm sure you got a good chuckle out of that, but my point isn't the irony in the statement, though it's not lost on me. What does it mean if the third largest exchange in the world, led by one of the most well-respected figures in that specific industry, who's considered trustworthy enough to inform government policy in front of Congress, can turn out to be a massive fraud and even get hacked, whether it was an inside or outside job, for almost $500 million? It means that legislators and regulators still have a lot of work to do when it comes to protecting customers and investors. The fact of the matter is, it's very much still the wild, wild west in the crypto markets these days, despite what you might otherwise be led to believe. And until the government manages to figure things out, the only person you can 100% count on to protect yourself in the crypto markets is you. Folks, cold storage. Let me repeat that. Cold storage, folks, or you will be Bankman-Fried. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.